play the video and then we'll play the video and then we can proceed. So let's start with the video, please, Sandy, and then we'll start with the formal content side of things. Thank you, Sandy, for showing that overview video about Atleha-edu. So today we're going to be talking about investment styles. So we're very grateful to Alan Gray and the Assisa Foundation, who have provided Atleha-edu with funding to develop 2 short educational articles, as well as 2 infographics. We'll be focusing on one of the infographics today, which is focusing on different types of investment styles or approaches. And previously, we have written articles on the time value of money. So the importance of giving your retirement savings or any investments and savings time to grow, as well as looking at growth investing or value investing, not growth investing, value investing, and what that means. And then we also did an infographic about diversification and the importance of diversifying your retirement fund investment portfolio, because you don't want to have all of your financial eggs in one basket. So diversification is a way of reducing your risk as an investor by investing in different types of investments or different asset classes. And yeah, Sandy's just showing us where we can access the diversification infographic, which will be coming up on the screen shortly. Yeah, so there's multiple ways to diversify your investment portfolio. So you could be investing in different types of assets or investment opportunities. You could also invest in different areas or regions, so geographic diversification. It could be diversification by industry or sector type. And sometimes these are even possible through the same asset class. So if one uses an example like investing in property or real estate, you could invest in hotels or hospitality real estate projects or opportunities, or you could invest in industrial or retail or healthcare property facilities. And so those are ways to diversify even within the same asset class. Again, you could diversify from a geographic perspective. So you could invest in healthcare or hospitality investments within the real estate asset class, but in different countries. So you could have investments in Europe or in the US or in South Africa or in Nigeria. Those are all ways to diversify within the same asset class. And then last but not least, you can also diversify by where the investment is sitting from a company size perspective. So you can invest in large cap, big companies, but you can also invest in smaller emerging companies that are active in the same sector. So there are multiple ways to diversify, and Regulation 28 of the Pension Funds Act actually is a tool to support and to assist retirement funds diversify their investments by setting out the upper limits that you can actually have exposure to with respect to different asset classes, but also to any single asset class or individual investment opportunity. And then I think it's the South African Reserve Bank sets out the limits for investing offshore. And so South African retirement funds are now able to invest up to 45% of their investment portfolio outside of South Africa, providing a further means to diversify from a geographic perspective. So we've already done a session on diversification, so we're not going to spend too much time on this particular infographic. So let's get to the investment styles infographic. And again, Sandy is demonstrating that all of these resources are available publicly via our website, www.atleha-edu.org. And then you just go under the infographics tab under trustee education, look for the infographics tab, and then you'll be able to see our various infographics, including our Alan Gray funded infographics. So the topic for today is about styles of investment and what are the most common investment styles. There's probably more than just the 10 investment styles that are put into this infographic. Some of the styles can be implemented at the same time. And what you find is that different fund managers or different pension funds that have got a fund management capability inside the fund will follow a certain style or styles of investment. So quite simply, an investment style is the method and philosophy that gets followed by an investor in selecting investments for a particular investment portfolio. So generally, when it comes to Atleha-edu, we are talking about the investment styles or preferences or approaches followed by fund managers who get appointed by or contracted by a retirement fund to make investments on behalf of the retirement fund, so that the retirement fund can pay pensions and other benefits to their retirement fund members. An investment style is based on several factors and typically tends to be based on investment parameters such as risk preference, growth versus value orientation, and or market cap preferences when it comes to the investor. So in essence, the style determines the subset of shares that an investor will consider within their asset selection process. So it is your guiding approach when it comes to investing. So maybe let's just unpack risk preference. So the more risk that you take on as an investor, the higher the return that needs to be offered to you as the investor in order to compensate you for the risk that you are taking on. So high risk investments are not suited to all investors because not all investors have got the same ability to recover from taking on risk. So equities, and specifically private equity or venture capital equity, would be higher risk than a loan or a bond type instrument to a company. And so when it comes to investing in equities, you can expect higher returns. And that is to compensate you for the risk that you're taking on, because you might buy a share at 100 Rand today. And even though it's a listed company, something might change. And we've got too many bad examples in South Africa, like Steinhoff or African Bank, or even Tongaat, the sugar company, where you might buy a share for 100 Rand today, and tomorrow it goes down to 30 Rand or 40 Rand a share. So you lose money over the short term if you are going to be trading and quickly buying and quickly selling. And so it's important that you understand as the investor what your risk preference is or your risk requirements are, and you make sure that you approach and appoint fund managers who are aware of your risk preference or risk requirements. So if you are someone that is very close to retirement, or you are a retirement fund that has got a large number of members who are approaching retirement, then you are probably more focused on protecting the investments that have already been achieved over the lifetime of those members' savings towards retirement. You don't want to take unnecessary risk for those members who are close to retirement and who don't have time to recover from an investment that might be deemed to be too high risk, where you could lose money over the short to medium term and might not have enough time to recover from any of those shocks or volatility. So what that would mean then is that you would be probably a little bit underweight in terms of investing in companies via shares, but maybe a little bit more overweight in terms of investing in debt type instruments where it's more of a contract and you are guaranteed to get your financial returns, and it is more of a loan type arrangement, and it is less risky than equity, but you will also get less returns than what your typical equity investment would provide because you're taking on less risk. But less risk is probably more acceptable and more appropriate for those retirement funds with a lot of members closer to retirement, or for an individual member's savings for retirement when they are close to retirement. So investment style matters because it's about finding alignment and agreement between yourself as the retirement fund and the fund manager or managers that you're going to be appointing. And so it is important when you have those discussions and engagements with your fund managers to understand, well, what is their typical approach to investing? And as I mentioned earlier, you'll probably find that in many fund managers, the actual approach or style that is followed could well be a combination of all of the approaches that we will be looking at today. So in terms of the common investment styles, we'll just tackle it from left to right, and we'll go anti-clockwise. We'll go clockwise, yeah. So, or anti-clockwise. So we'll start with active investing. We'll then go down to growth investing, value investing, and then end up with dividend growth. So active investing is when your fund manager is going to be actively trading the investments. And so they are going to be closely monitoring movements in share price. They're going to be researching and reading up on all of the companies that they own. And they are not necessarily going to be loyal to a particular company. They are looking at opportunities 24/7 to move out of one company that they think is going to perform less well and move into another company that they view as being a better performer. So you are going to be actively investing against a specific benchmark. When they invest actively, they take bets against a benchmark. And at the end of the day, their aim is to outperform or to get alpha above a particular benchmark. So with active investing, generally you are paying for a more active style and approach to investing. And it will be measured, the performance is always measured against a particular benchmark. And so active investors, you will see regular changes in your investment portfolio as they buy and sell out of certain investments, buying into investments that they think are going to outperform and selling out of investments that they think are going to underperform over the short to medium term. That's active investing. Growth investing is an investment style where you are looking to invest in growth assets or those companies whose earnings and performance are expected to be better than their industry peers or the sector or the overall market. And so growth investing is investing in those companies where you see greater growth potential than in your industry peers or the market itself. So you are looking for the next big, popular company. You're looking for the next big Naspers or Prosus or the next Sanlam or Old Mutual or Tesla. It's looking for those assets that are going to give you market-beating growth, industry-beating growth. On the other side, value investing is when you invest in those companies that you deem to be undervalued or underappreciated by the market. And so you can actually get a good asset at a cheaper price. So value investing is when you buy the company or the share of the company when the share is low or lower than its market peers, but you think that over time the company is well valued and it's going to give you that additional financial return. So value investing is typically a longer term investment approach where you will buy an undervalued asset in terms of what other investors think about the asset. You hold the asset for a period of time, and then you make your money when the share price increases back to its intrinsic value or the value that would be a more appropriate value for that investment. So Alan Gray, for example, typically follows a value-based investing approach where they will buy companies that are good companies, that have got good management, that have lots of potential, but the market is not necessarily seeing that. And they will buy that investment and hold that investment for many years. And investors are able to engage with company management to bring about certain improvements in governance or performance or financial reporting. Those are all ways to add value to the company. And hopefully you will see improvements in the financial value of your investment over time. So that's value investing. Momentum investing is when you buy those companies where there is a kind of a market trend that this company is growing, it's attractive, the market likes what they're seeing, and it looks like there's going to be growth momentum in this particular company or sector. So investors will invest in those opportunities where they're seeing year-on-year improvements in growth and performance. And these are popular companies. You probably are seeing, good demand for their shares. And the investors that are following momentum investing, when they see that perhaps the growth of the company is starting to slow down, or it's nearing the peak of the investment, they will then actually start to sell out of those types of investments. So you want to kind of benefit from that momentum, and the momentum is heading in the right direction. And as long as the momentum is going forward and not stabilizing, the momentum investors will continue to buy. The minute the momentum investors feel that the company share price has reached its maximum levels, they will then start selling. So the ideal is always to buy low, sell high. So you want to buy a share at a low price and you want to sell it at a higher price, because that's where you get your capital gains. So that's momentum investing. Multi-asset investing is an approach where you, again, diversify to reduce risk. And so you will probably have what is often referred to as a balanced fund, where there will be a portion of the portfolio invested in listed equities, which are a little bit higher risk than some of the other asset classes like cash or bonds or fixed income. And so you distribute your investments and your investment portfolio across a number of asset classes. So this is what Regulation 28 is trying to achieve as well, where it specifies certain regulatory limits where you're not allowed to invest, for example, more than, say, 75% of your investment portfolio in equities. You can, however, have 100% of your investment portfolio in government bonds and in some other asset classes which are deemed to be less risky. But again, risk depends on your own context and situation. So if you have a lot of fund members and you obviously need to pay pensions that are going to be needing to keep pace with inflation, it's risky to invest in an asset class that is not going to necessarily keep pace with inflation. So as much as Regulation 28 allows for you to keep your entire investment portfolio in cash, cash is going to underperform all other types of asset classes over the long term. And so if you put all of your money for your pension fund in the bank, it is not going to be able to keep pace with inflation. So that is just as risky an approach as investing in those more riskier asset classes. And so that's why it's important that you take a balanced approach, you diversify, and that's what multi-asset investing allows for. We are now heading to the right-hand side of the infographic, starting with dividend growth. So what is a dividend? A dividend is what gets paid to investors when they share in the profits of a company, and the company pays out generally cash to its shareholders. So let's choose any company. It could be, let's say it's the Lego company who produce Lego bricks, and they have made a profit. And so they will keep some of the profit for continued growth of the business, but the remaining profit will be shared between all the shareholders. So you will get paid out cash as a shareholder on a pro rata basis it'll be a certain amount of money per share that gets paid out. So the more shares that you own, the more dividend payments you would receive. So it's a company's way of sharing its profits with its shareholders. So if you buy 100 rands worth of MTN shares, and let's say you have 2 MTN shares, just I'm making this up now, you might find that MTN will declare a dividend for shareholders, and the dividend might be 5 Rand per share. So if you own 2 shares, you would get a cash payment of 10 Rand for your 250 Rand shares, your 100 Rand investment in MTN. And that gets paid probably in all likelihood once a year if the company is profitable and declares a dividend. It's the board of directors of the company that makes the decision about whether or not they can afford to declare dividends. And in certain market situations or economic cycles, companies that are unsure of the future, they might decide to hold on to their cash and their profits, or they might actually distribute to shareholders. So that's dividend growth, where you are specifically going to invest in those companies where you are confident they are going to continue paying out regular dividend payments to their investors. So for dividend growth, you are investing not only for the capital growth that you'll see in the share price, hopefully appreciating in value over the short to medium term, but you are also making reliance on the regular payments of dividends from those particular companies. And so if you're following a dividend growth strategy and the company that you've invested in stops to pay out regularly dividend payments, then that is probably when you as a dividend growth investor would sell your shares in that particular company or sector. So there are certain sectors that are well known for dividend payments. One example that comes to mind is the listed property companies or real estate investment trusts or REITs, where you can imagine you own a property, you're getting rental payments very regularly. It's fairly easy to keep track with inflation because you increase the rental agreements by inflation. And so REITs are able to pay, for the most part, fairly frequent dividends to investors. But of course, we've just had the COVID pandemic. We see people are no longer working in a physical office. So those listed property companies that invested heavily in corporate real estate, for example, leasing their buildings to corporate tenants, their investment performance has come under difficulty, and they are making less money because they've got fewer tenants and higher vacancy rates compared to occupancy rates. And so they are not able to pay the dividends that they would like to. And that's an example of a dividend growth strategy. Passive investing is, one could argue, the opposite of active investing. So when you are an active investor, you are regularly buying and selling out of companies based on your active research on the company. So you are kind of very close to understanding all aspects of the company, and you're following the newspaper, and you are very active and mobile when it comes to active investing. Passive investing is an approach where you rather own a section of or a collection of shares that track a particular benchmark or index, and you basically buy and sell out of companies according to their weighting within a particular index. So this is, generally speaking, a cheaper way to invest because you need less management time, or you need less expertise in terms of passive investing, because you are following what the market is doing. You are following how the market is investing. And you're just following a benchmark or following an index. Whereas with active investing, you are taking bets against the market. You are taking bets against the index, and you are expecting to be rewarded for taking on that additional risk. Passive investors, especially the die-hard passive investors, say the market will always win. You can't beat the market. So why pay extra fees for betting against what you know is going to be the outcome in any event, with the index or the market being the market? So that's passive investing. You will track the index. You are not going to be taking bets against the index. It's basically getting market-related returns with less risk than active investing. Buy and hold is probably also quite closely linked to passive investing, where you buy and hold a particular investment. And for retirement funds, this can work very well, because basically you buy the investment and then you forget about it, and you just let it grow organically in your investment portfolio, and you will get the benefit of that after a 5, 10, 15, 20 or 30-year period. Now, that can work quite well for retirement funds, because many retirement funds have got a large group of relatively young employees in the workforce, and those employees are only going to need their retirement fund benefits in 20, 30, 40 years' time. So, it's appropriate then to be buying the likes of an MTN or a Vodacom, equivalent emerging companies, where an MTN or a Vodacom would have been 20, 30, 40 years ago, and you get all the benefit of being a patient investor and just continuing to be with that company over the long term as a patient shareholder. So that's the buy and hold strategy. So the buy and hold strategy is also the complete opposite to active investing. Active investing, you are buying and selling all the time or very frequently. Buy and hold is you will really have to be shaken to leave a particular investment, because your strategy is rather to buy the investment, to hold on to the investment, and to only sell it under specific conditions. Now, a good example of buy and hold and passive investing is Warren Buffett and his Berkshire Hathaway Group, where he owns only through his Berkshire Hathaway Group investment manager, he owns only a kind of a relatively small number of companies, but he buys a big stake in those companies and he holds on to that investment. And he works with company management to bring about change, etc. So that would be the buy and hold investment approach. And you can just imagine if you bought into Coca-Cola or South African breweries, and you just hold on to that investment for the long term, you will be very well rewarded for staying with the company as it continues its growth journey. We're getting to the end of the 10 kind of most common investment styles. Market capitalization is when you are investing in companies that are at a specific place in the market. So they've got a specific market share or market cap. So your largest companies will be JSE top 40 companies or top 100 companies, the 100 largest companies on the Johannesburg Stock Exchange. So they would be high market cap companies. So you could say, look, we are going to invest in only the largest companies by market cap. Or you could say we're going to invest in mid-sized companies that will be more in the second half of the market. Or you could be investing in smaller companies, or what are sometimes called penny stocks or penny shares, although these are not really suited to retirement funds because they are so small that they can't really absorb the capital that retirement funds typically need to invest. So market capitalization in South Africa, because we don't have so many listed companies, we don't have such a big listed equity investment universe. By market cap, you actually find that we have some companies that are overweight in terms of our top 40 or top 100 index. And that's because we've got companies that are so big relative to some of the other companies in the top 100 list of companies. So one of the culprits is Naspers or Prosus, where at one stage, Naspers, if you were following the top 40 index, Naspers' weighting by market size or market cap relative to all the other top 40 companies was 30% of the index. So if you were just following the index and you were following the top 40, you would have investments in all these top 40 companies, but 30% of your investment in the top 40 would be made up of Naspers because it was so big relative to the other large cap shares. And interestingly, Naspers, its attractiveness and popularity by investors is not because of all of the South African businesses that are owned by Naspers. And at one stage, MultiChoice or DStv was owned by Naspers and was represented by Naspers as the listed entity, but now MultiChoice is a listed company in its own right. But market capitalization is again something that can apply in the South African market, but also internationally. And so if you are investing in Google or its parent company, Alphabet is the name of Google's parent company, or Facebook, or Tesla, or some of these other big market cap companies internationally, that would be a market capitalization approach. And then last but not least, low risk investing is when you buy shares based on their stability and low volatility of the share price. So low risk investing is probably most appropriate to those investors that are nearing retirement, those investors who are not so far away from retiring, because you are not wanting any surprises. So you don't want to invest in those shares where there will be a lot of volatility in the value of the share price, because you don't want to have your retirement fund value at 100 Rand today, and then tomorrow it's 50 Rand, the next day it's 30 Rand, because it's too risky. You need to know, that there's stability, and you need to know exactly what you will be retiring on at the time of retirement. So that's low risk investing. And generally, from a diversification perspective, what will happen is you will appoint a number of fund managers as a retirement fund, and each of those managers will have their own investment style. So you might find a few of those managers being active managers. You might find a few of those managers being passive managers, and they are going to own shares of the same companies, but with a different view on those companies. And so you will have different managers buying and selling shares at different times based on their view on the future, the economy, and their view on the future performance of those shares. So again, it is a form of risk management where you are not putting all of your eggs in one basket, and different investment styles will perform well under different market circumstances. So in some markets, active investing will pay off, and that's generally, in my understanding, is that active investing will do very well in a market that is growing, a bull market, a market that is lively and there's strong economic growth. That's when you'll see active investing paying off. Passive investing will pay off when there is lots of market volatility, the economy is not doing well, and you want to basically just track the market because of all the volatility in the market. That being said, there are fund managers who will argue that whenever there is volatility in the market, it presents an opportunity to buy and to really get a good return. One of the workshops that I will never forget was a workshop that we ran in Cape Town a couple of years ago. I think it was the week before the start of the hard lockdown for COVID. And Sasol's share price halved during the first day of the workshop. So Sasol's share price was decimated. It lost 50% of its value on day one of the workshop. And we spoke about it in the workshop. And the next day, it bounced back to the regular price for the Sasol share price. So that was a great buying opportunity. And again, this would have been attractive to those who are active investors or those who are following a value investing approach, because it would have presented you with an opportunity to buy a share at a 50% discount. And if you like me and you like a bargain, if something is 50% off, I'm going to smell it to see, is this a good opportunity or not? And so if retirement funds had bought, or through their fund managers had bought Sasol shares, when the share price was at 50%, there would have been a great opportunity to make money and to add additional returns for retirement fund members. So am I saying that you need to bet and be actively trading on company shares? No. It's important that you understand the risk aspects. And for retirement fund investors, investing, we need to be patient investors, we need to be responsible investors, and we need to understand our risk appetite. We need to understand our liability requirements, what our mix is going to be in terms of investing in South Africa and in the rest of the world. But if you have money to spare and you have a little bit of money that you want to invest in companies, then there's nothing stopping you from investing in listed companies. And today, most banks or other investment platforms like Easy Equities, for example, which you can access via Capitec, or you can access it via an app on your phone, you can actually buy shares of listed companies yourself in your own name, and you can start saving in addition to your retirement fund saving. And then if you are happy to take on a bit of risk, then you could actually buy shares in Sasol, for example, when you see that they are undervalued and they are half their usual share price. There might be an opportunity to make a good financial return on those investments. So it's another way of actively saving, but it does come with risk, and it is certainly far more risky than putting your money in the bank on a fixed interest deposit or something similar. So I see we're coming up to the hour. So let's create an opportunity for any questions or comments. It's been great that we've had a few more folk join us during the course of the session. Are there any specific questions or comments anybody would like to raise? You're welcome to do that in the chat function, or you can just raise your hand and ask a question or make a comment. Very happy to try and answer any questions you might have. Zamo, I see that you've got your notepad out. Do you have any questions?
Hi, can you hear me?
I can hear you, yes.
Yes, man. Sorry, man. I'd like to firstly to introduce that Zamo Manyati, Samo member in Jimmy's team. Yeah, I was battling to connect this morning, but unfortunately, yes, I did. Can you hear?
I can hear, yes.
Yes, yeah, but then I've just picked up some few that you just presented, like the common investment style, whereby you can't keep your money in the bank, and then you need to check where you can invest your money, like Alan Gray, for instance, if you go up for pension. So it's just a recommendation, because now, yes, at the bank, I don't think that your money will grow if it's been invested to the bank. So I just heard stating about also the share dividend, but I didn't hear more especially because if you invest to property for maybe for 15 years you bought the property, so now you want to sell it, are you gonna get are you gonna get a better profit of that amount, or you are allowed, or you can either leave it for some years? Thank you.
Thanks for your question, Zamo. Just to clarify on that property, is that property what you own? You owning the property as an investment. It's not your
Yes.
It's not your home. It's not your home that you're living in.
No, I'm living in it, but now because of the situation, maybe I need to go and buy another house, or just to the way of making a living, you see, or so that you can have the money or start another, buying a new development mortgage, for instance. Is it a good idea?
Well, I'm glad you're asking that question because, yeah, we're not financial advisors, so we can't tell you whether it's a good idea or not, because that's not what we do at Atleha-edu. So, you know, again, property and directly owned property can be a good investment. So we were talking about growth investing. Value investing, and investing in something when it is undervalued relative to the market. So if you are buying a property off plan and it's a new construction, it's a brand new property development, there is the opportunity for you to buy the property off plan. So the building doesn't exist yet, but you are putting a deposit down and you are buying that with a view to the future so that you can then rent it out to a tenant and you use that as an investment. Generally, there is an opportunity to get an above market related return, because you're basically putting some money down and you're still going to have a year or two before the property is available and it's been built and it's available to be rented out. There is often the opportunity to make a little bit of extra return on your investment, as opposed to buying an existing property. When you buy a new property and it hasn't had any previous owner, it's just the builder or the developer. What's also nice about that property is you do not have to pay transfer costs. And property transfer costs can also work out quite expensive. So that's another cost to your investment that you can save yourself. But investing in property is a long-term investment because you can't sell your property very quickly. So you need to be able to make sure that you've got the necessary monthly income and cash flow to be able to pay the bond or to pay the monthly costs. Even if so when you don't have a tenant that is helping you to subsidize or pay those costs. So property can be a good investment. It's not a good investment for everybody. And in actual fact, some people say that you could do better by being a tenant and renting your main residence where you live, because often there is a discount. So tenants pay less generally than what the owner of the property is paying in terms of the monthly bond costs. And you could use that money that you're saving to actually invest in the stock market, which will outperform all other types of investments over the long term. So I'm not giving you investment advice. I'm just saying it's important that you consider all the aspects before you commit to any individual investment, especially an investment like a property, which is typically going to be a longer term investment, and you're going to lose money if you need to auction the house or you need to sell it quickly, or the bank is not going to be understanding if there's a number of months where you're not able to pay your bond. So Mzamo, those are some things to think about before you invest in property. If you want to invest in property, but you want to be able to buy and sell the property quicker, then maybe investing in what is called listed properties or REITs, real estate investment trusts, where you let other companies do the property development, the property sales, the property leasing to tenants. They do all of that for you. That is another way of getting exposure to investing in property, but without the headache of having to do things yourself. Yeah, so Mzamo, I hope that's helpful. And then Puleng asks, under value investing, Alan Gray is offering long-term investments. So I want to know for how many years? Thank you. So that will depend on what you are looking to do through a product from Alan Gray or any other fund manager for that matter. Alan Gray says that they are long-term investors in terms of their corporate profile and their kind of communications and marketing to their investors and potential clients. So if you are going to be taking out a retirement annuity with Alan Gray, then it's effectively going to be a long-term investment where you will invest a portion of money every month until you retire. And then when you retire, you will then be able to either get that money paid out to you as a once-off lump sum, or you will need to get paid that as a monthly pension. So Alan Gray can offer you, like any other investment firm, can offer you long, medium, or short-term investment opportunities, and it will really depend on what you are looking for. So they've got a variety of products and solutions, as do all fund managers in terms of your own investment needs. So it's an important thing to have a financial advisor, and you get financial advisors that don't get paid by you. They get paid commission based on the products that you will be buying. But then you also get financial advisors that you pay them for their time, and then they are not linked to particular investment product providers. They could give you investment products from any provider. So there's different approaches that you can take, but a very important thing is to speak to a certified, registered financial advisor who's a reputable person, ethical person, who can understand your income levels, your assets, your expenses, your debts, and they can help plan with you for your future and how best to make those investments on your behalf. And if you are not part of a retirement fund through your employer, then probably one of the first things you can speak to them about is investing for retirement, but they can also assist you with investing for your children's education or your grandchildren's education. They can help you with investing for a deposit on a car or a house, and the investment value that you need to commit on a monthly basis can start from very little. In many instances, it's 100 Rand or a couple of $100. So these are all opportunities to invest, and in all of our workshops and sessions like this, we stress that this is not about making you rich quickly or getting rich quickly. This is about putting a little bit of money away day in and day out, so that at the end of the day, when you are ready to retire, you've got enough to retire with, and you don't have to go and stand in the queue at the SASSA or the post office line for SASSA grant payment. So I hope those answers have proved helpful. Again, we are not experts or financial advisors, and that's why we encourage you to engage with a professional financial advisor. So I'm glad, Puleng, that our response was useful. I think we might have lost Mzamo. I think he might have needed to rush off to another meeting, or he's just moved on my screen. Okay, so if there's no further questions, maybe just to say a big thank you again to Alan Gray and the ACESA Foundation for funding this online session. We trust that it's been useful to you. Please do have a look at all of the links that we've provided in the meeting chat. And we look forward to hosting you for another session in July. And we'll also be in touch about new opportunities for in-person workshops in the second half of the year as well, also starting from July. So thank you, Sandy, for your assistance and support. Thank you to the Atleha team. And thank you to all of you for joining us today. We really appreciate your time. Thanks very much, and go well, and God bless.